Today, we are opening up an analysis report that has landed on our desk with a truly sensational claim.
It really is.
We're looking at a major player in the AI infrastructure space, CoreWeave, ticker CRWV, and this report projects a staggering 72% upside potential.
And that's a number that just, it makes you stop and pay attention. So our mission today for this deep dive is to really act as your guides through this source material.
Right.
We're going to unpack this detailed analysis, focusing only on CoreWeave's valuation, its growth story, and those very specific price targets.
And the big question we're trying to answer, based just on this report, is whether this stock is truly the most undervalued AI play out there today.
Exactly.
Okay, let's unpack this. So the foundation of this whole bullish argument, it seems to rest on this massive disconnect.
A verifiable disconnect, yeah. The report argues CoreWeave's current price is just completely out of sync with what the pros on Wall Street are expecting.
And at the time of the report, we're looking at a stock trading right around, what, $74.92?
That's the number. But that number is almost misleading without the context.
How so?
Well, the report stresses this point, that price is about 60% below its 52-week highs. 60%.
Wow.
So when you see a high-growth name get cut down that far, it's really one of two things. Either the business is broken, or you're looking at a spectacular opportunity.
And that 60% drop is what creates the room for that 72% potential comeback.
That's the math. The report cites the average analyst target price, which is way up there at approximately $129.49.
So the move from around $75 to that $129 target.
That's your 72% potential gain right there. But here's where it gets really interesting, to me at least.
Go on.
Despite that massive price drop, the analyst consensus is still, overwhelmingly positive.
Right. The report highlights this. It says there are 14 strong buy ratings.
14.
Versus only one single sell rating. How do you square that for the listener? How can the professionals be so confident, 14-1, while the stock has collapsed 60%?
And that's the core disconnect the report is all about. The analysts believe the fundamental long-term story is still completely intact.
So the sell-off was just noise.
They see it as noise, driven by temporary concerns, things like supply chain hiccups, short-term cash flow issues. They're basically saying the market is mispricing CoreWeave based on short-term fear.
And failing to see the long-term engine.
Exactly. They see the underlying value holding steady, despite all the fear in the price.
Okay, so let's talk about that upside potential. The report doesn't just stop at the average target. It introduces this blue sky scenario.
The extreme bull case, yeah. The highest single analyst target cited is a breathtaking $245.
$245. That implies the stock could more than triple.
A return of plus 226%, to be precise.
Wait, a triple? That's an enormous leap. Does the report actually detail what needs to happen to justify that kind of valuation? Because flawless execution feels like a huge ask.
It is a massive leap, and the report is clear about the risk. That $245 is the absolute ceiling. It's the theoretical maximum.
So what does that assume?
It assumes CoreWeave maintains its lead, gets every single cutting-edge chip from NVIDIA, the H100s, the new Blackwells, and scales its data centers ahead of schedule. No missteps, no delays, perfect partnerships.
And no competition from the big guys.
Zero competitive erosion. It's the absolute best-case scenario. It sets the ceiling for what's possible.
Got it. So let's move away from the ceiling and get back to the core argument. Why does this report call the sell-off a golden opportunity? I assume it starts with the financials.
It has to. The report titles the section, Hypergrowth in a Slowing World.
Which is a great headline.
It is, because while a lot of big tech is slowing down, CoreWeave is doing something really rare. Triple-digit growth.
What's the number?
Revenue grew by a colossal 134% year-over-year in Q3. That's not just growth, that's explosive expansion.
A number like that suggests they're doing something fundamentally different, and that leads right into what the report calls their competitive moat.
Exactly. They've been called the NVIDIA of cloud, and there's a reason for that.
Okay, break that down.
So, you know the generalist cloud providers. Your Amazon AWS, Google GCP. They try to be everything to everyone, basic storage, websites, you name it.
Right.
CoreWeave is the opposite. They are a specialist. They build infrastructure focused exclusively on high-performance NVIDIA GPUs.
But why is that specialization such a strong advantage against trillion-dollar companies?
Because their entire company, from the concrete floor to the software, is built for one thing: running AI workloads as fast and efficiently as possible.
No baggage.
No legacy baggage. So they can build these huge AI clusters faster, they can manage the power and cooling better, and crucially, they can do it cheaper than the giants.
And that focus, that optimization,
Yeah.
that has to be where their pricing power comes from. The report calls out their insane gross margins.
And that margin figure, for me, is the best validation of their whole strategy. CoreWeave reported 73% gross margins.
73% for an infrastructure company.
It's phenomenal. It proves that clients are absolutely willing to pay top dollar for immediate, guaranteed access to those scarce H100 chips. They're selling a scarce resource very, very efficiently.
And the quality of those clients is also a big validator. The report calls them the whale backers.
This is critical. We're talking about deep partnerships and massive contracts, billions of dollars, with Microsoft, Meta, and even NVIDIA itself.
So when Microsoft or Meta signs a deal that big,
It's more than just an investment. It's a high-level technological endorsement. They're saying CoreWeave's tech is good enough and reliable enough to build their own AI future on. You can't really discount that.
okay, now, for a balanced view, we have to look at the other side. The stock dropped 60% for a reason. So let's hit the bear case, starting with the biggest concern, their spending.
Right, capital expenditure, or CapEx. The report specifically cites $747 million in negative free cash flow.
And for a listener, what does almost $750 million in negative cash flow really mean? Is the company just bleeding out?
That's the crucial distinction, isn't it? Negative free cash flow means more cash is going out than coming in.
From operations and building things?
Exactly. But the report argues this is not a sign of a struggling company. They call it good spend.
Good spend.
This cash drain is almost entirely from one thing: buying GPUs at scale and building the data centers to house them. They're spending money to buy assets that will print more money the second they're plugged in.
So it's an intentional investment in future growth.
You're buying the machine that prints money, and that machine is expensive up front. They are aggressively building that moat we were talking about.
Okay, what about the second big concern? The report says CoreWeave isn't profitable yet on a GAAP basis.
And that raises a really important strategic question. Should immediate GAAP profit even be the goal right now?
What's the report's take?
It provides a strong rebuttal, linking it to history. CoreWeave is in the land grab phase.
The Amazon analogy comes to mind here.
It's the perfect comparison. They're prioritizing market share and building capacity over short-term accounting profit, just like Amazon did for years while building AWS.
Right.
The argument is that in a brand new trillion-dollar market like AI compute, scale is worth far more in the long run than a small quarterly profit today.
But that strategy is riskier today, isn't it? With higher interest rates, capital is expensive. Doesn't that make the land grab more dangerous than it was for Amazon?
It absolutely does. The risk is higher, but the report counters that by pointing to the nature of the demand,
Which is off the charts.
far outstrips supply. So CoreWeave has incredible revenue visibility. They can pre-sell every single GPU hour they bring online. Their high gross margins give them a buffer. They aren't fighting for customers. Customers are fighting to get access to their hardware.
And that guidance cut we mentioned earlier, was that a big part of the price drop?
It was, but analysts saw it as a temporary hiccup. And the reason is key. The guidance cut wasn't because customers were leaving. It was purely due to supply delays in getting the chips from NVIDIA. If demand was dropping, that's a red flag. But if you can't meet demand because you can't get the hardware fast enough...
That's actually a sign of how strong the demand is.
Precisely.
That context is really useful. So let's shift to the technicals. How is the stock actually behaving in the market right now, according to the report?
The technicals suggest the panic selling might be over. The report details a significant support level. It says the stock has found a solid floor in that $70 to $75 range.
It's bounced off that level multiple times.
Exactly. And when the report says institutional buyers are stepping in there, what does that signal to you, the listener?
That the big money sees value at that price. They think it's undervalued.
It signals stability. These institutions, hedge funds, pension funds, they've done their homework. When they repeatedly buy at a certain price, it suggests they see that as the true floor for the business.
And now we're in a consolidation phase.
Yes. And historically, this kind of quiet consolidation after a big drop is often what comes right before a major breakout. It's like a base of buying strength is being built.
So what's the first hurdle they need to clear to prove that a breakout is coming?
The report identifies the immediate resistance level at $90.
$90.
Breaking through 90 is seen as the key catalyst, both technically and psychologically. If the stock can get above $90 and stay there, that could trigger a very rapid run back toward the triple digits.
And open the door to that $129 analyst target.
That's the idea.
So let's put it all together. The growth, the moat, the spending, the technicals. What's the overall synthesis from this analysis report?
The conclusion is pretty decisive. The market is pricing CoreWeave like it's a broken company.
But the numbers tell a different story.
A completely different story. The triple-digit growth, the 73% margins, the contracts with Microsoft and Meta, They show a company that is anything but broken. It's a company aggressively building a massive moat in the hottest sector of tech, using a proven, if risky, land grab strategy.
Which brings us back to that risk-reward ratio.
It does. The final verdict is that for an investor with a higher risk tolerance, someone looking for the next big thing in AI infrastructure beyond just NVIDIA.
Which is already a multi-trillion-dollar company.
Right. CoreWeave, at around $75, presents a hugely compelling risk-reward scenario. The report's bottom line is this. If you believe the AI trade is far from over, then CoreWeave is arguably the most undervalued way to play that infrastructure build-out today.
That was a tremendous deep dive. The key takeaways for me are clear. You have 134% hypergrowth, you have this specialist NVIDIA of cloud moat, driving premium prices and 73% margins, and this huge 72% gap between the current price and where Wall Street thinks it should be.
And that specialization is really the thing you should keep thinking about. CoreWeave's entire high-margin business is built around providing immediate access to premium NVIDIA chips. So you have to ask yourself,
What could change?
what strategic shift, what new chip architecture, or the rise of a new competitor could actually change the core demand for such a specialized cloud? The future of CoreWeave is in many ways tied directly to the continued dominance of NVIDIA's ecosystem. That's the long-term strategic factor to really dig into.
An excellent provocative point for our listener to chew on. Thank you for joining us for this deep dive.